Hello, and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is one of my partners, Pete Cahill, one of our senior portfolio managers. Pete, stock market, particularly the S&P and NASDAQ, has gone through a 10% correction in a relatively short period of time, and that means tensions and client calls have all increased over the last couple weeks. In fact, during one of our conversations recently when you stopped in, you had some interesting observations from about 3 years ago. Can you share some of that with us?
I don't know if they're interesting, but they do remind of 3 years ago. 3 years ago, a little over 3 years ago, Russia was on the doorstep of invading Ukraine. The stock market was down around 20%. Tensions were high. What Paul and my colleague and friend Rob Romano did 3 years ago is they filmed one of our market share videos where they talked about Ukraine and they talked about conflict and Ukraine's economy and the economy, the impact it might have on inflation and Federal Reserves and interest rates. And Rob also talked to our clients and our listeners about the importance of corporate earnings. So it's a long-held investment axiom that it's important to keep your head when others are losing theirs. So we provide straight talk and sound advice, and it just reminded me of that 3 years ago. I think it's a good lesson.
In case you're all looking, you can go to YouTube and look 3 years ago, and you'll find Rob Romano and I talking about that video. Obviously, I just mentioned that we had the 10% correction in the stock market over a very short period of time. I think you had mentioned it's like the fifth fastest drop of 10%. One of the observations our clients may not be aware of is that some of the market metrics that we follow were kind of expensive.
Yeah.
Can you explain a little bit about that and where we are today?
Yeah, so we come together formally as a team once a week to review these metrics you were talking about, Paul. What is a fact? 2023 and 2024, the stock market was up over 20%, and that's fabulous, and it was driven by earnings. But sometimes markets get ahead of themselves. So if we look at this next graphic, this is looking at what the valuations were of the S&P 500 and the tech sector going back to February of this year, just a few weeks ago, and then March 17th. And you can see as of February 24th, the S&P was trading at 22 times earnings, which was in the 91st percentile in history. Just 3 short weeks later, where we had corrected, the S&P had come down to a price earnings multiple of 20, which is in the 66%, and that's a 9% correction. Now, I put technology here because that was really driving a lot of it. It drove us on the way up, and the air pocket we've hit. Technology was selling darn near 30 times earnings back in February. It's down 14%, and that's moved it down to 25. So corrections are never fun to go through, but sometimes they're a necessary part of investing.
Right, and we even have some clients who've called up and say, hey, is it a buy opportunity for the first time in about 2 years? So I think that's a healthy sign that our clients are paying attention and having great conversations with us. As this video is going to go out, Pete, it'll be near April 2nd when the president has talked about announcing specifically tariffs. And it's really kind of interesting in our research that our trading partners and the market has really changed over the last 5 years, 6 years, really due to supply chain issues coming out of COVID. Can you educate us a little bit more on that?
Yeah, I'd be glad to. I mean, we have been hit seemingly by the hour with news on tariffs, and tariffs are definitely related to trade. But one of the things that Paul just mentioned about is that when we went through COVID, our supply chains, to put it politely, were strained. And so I'd like you to take a look at this next graphic that looks at the U.S.'s top trade partners by value. The dates stretch from 2017 to the end of 2023. And you can see going back in time, China was far and away our largest trading partner. At number one, we imported over $500 billion of goods from there. They are now number 2. Mexico has supplanted them with a trade value approaching that $500 billion. And I would suspect when the 2024 numbers come to print, you'll see it closer to $500 billion. And then you can see much talked about China is our number 3 trade partner and likely to be our number 2. So there's a lot of headlines, but it's important that ultimately I think it shows that our supply chain is strengthening.
So obviously it's strengthening, but it obviously has caught the attention of the markets and how tariffs might be implemented and why we have this new trade imbalance with Mexico and Canada. So as always, Pete, I appreciate your thoughts and insights. Those are great things as we go through these volatile times. Our goal is obviously to provide you straight talk and sound advice, always keeping your best interest in mind over the long term. If you enjoyed today's video, I encourage you to share that with your friends or family. If you do not currently receive the market share, you can subscribe using the QR code at the end of the video. And as always, thank you for the opportunity to serve you and your family, and have a great day.